Hey guys, Joel Frank here, market analyst for YouTrading, and in today's video we're going to be taking a quick look across markets. I'm going to be giving you a bit of an update as to what's happening, so let's jump straight into it. We're basically on Wednesday seeing a bit of a reversal, or not a bit actually, quite a big reversal of some of the moves that we saw earlier this week. So first of all, what moves did we see earlier this week? We saw the dollar weakening, we saw yields across the world, but particularly in the US, falling. We saw stocks rallying and other commodities rallying and pretty much most currencies rallying against the dollar. Why were we seeing that? Well, there was a mixture of things. There was weaker than expected US manufacturing PMI data. There was the UK government's reversal in its basically economic plan, where it was going to be cutting taxes for higher earners. They've axed that part of their plan, which has sort of allowed sentiment in UK markets to improve a little bit, which has put downward pressure on global yields. We also had a smaller than expected rate hike from the RBA, which sort of helped the market get over some of these concerns about rapid, aggressive rate hikes from central banks. And those factors were pretty much meant that people were taking profit on the dollar, people were buying bonds, and it was a risk-on environment. However, like I said, we're seeing a bit of a reversal on Wednesday. Now, why are we seeing a reversal? Well, I mean, let me just show you the economic calendar. First things first, you had a very hawkish RBNZ last night. They raised interest rates by 50 basis points, not like the RBA a day earlier, who surprised markets with a 25 basis point rate hike when markets had been expecting a 50 basis point rate hike. Now, this is the RBNZ's fifth consecutive 50 basis point move, and you know, it kind of reminds the market that aggressive monetary policy tightening across the world is currently the norm, and maybe the RBA is the exception at the moment. Then you also had a couple of things. Now, this is weighing particularly on the euro. You had these final PMI readings for September, which are actually worse than the preliminary readings that we got last month, basically showing that the German economy and the Eurozone economy is contracting at a faster pace than we originally thought. So is the Eurozone recession already here? Looks like it could be. Now, the UK PMI data, final PMI data, was a little bit better than expected, but still nothing to cheer about, because look at that, it's still below 50, still implies that the UK economy is currently in contraction. So all of this together, weighing on sentiment in European markets. You can see here I've got euro dollar one-day candlesticks. You can see euro dollar is down 1.4%, that's hefty, and cable is down nearly 2%. So yes, this reversal is happening, but it's not just because of European events, it's also because, let me show you the US data. ADP non-farm employment change, that's like ADP, that is the payroll company in the US. They kind of put out this estimate before the NFP reading, the official government NFP reading every Friday. They put it out on the Wednesday, and it was a little bit stronger than expected. I mean, 208,000 jobs added in September. That's robust. That's still a solid labour market. So that's helping the dollar rebound, helping US yields rebound. And then look at this as well. We had ISM non-manufacturing PMI 56.7, a little bit lower than last month, but still, you know, above expected 56, and still that's a very robust number. Business activity, when you're looking at the sub-indices anyway, strong. New orders still strong. Employment improved actually versus August, and prices came down a little bit, but still high at 68.7. So that's a strong report. So those two reports taken together definitely giving US yields a bit of a boost today. Plus, you know, all the stuff we were just talking about with the RBNZ. Now, let's just talk some technicals. Go back to euro dollar. I was saying earlier this week, and I think it was actually yesterday, that I was thinking that this downtrend would remain in place, and looks like for now that's been a good call. We weren't able to get above parity, weren't able to get above that 50-day moving average, and you know, markets are choppy at the moment, and you know, we could see another little reversal higher depending on how today's session how tomorrow's data goes. how Friday's US jobs data goes. But I think for now we're probably likely to continue heading towards the south for the reasons I explained earlier this week. Fed being more hawkish than the ECB because of the stronger US economy and the tight labour market and the still very bad inflation situation, and the US economy outperforming the Eurozone economy. Those factors, they just mean that I don't think you can argue for a rebound. I mean, maybe you could get a technical rebound to this 102 resistance area, but back to this 103.50 resistance area, I just don't see it right now, unless there's a change in the fundamental backdrop. Let's move on to stocks. Stronger dollar, yields rallying once again, stocks falling. Makes sense. So we've got the S&P 500 down about 1.5, 1.6%. Wasn't able to test its 21-day moving average. Wasn't able to get above 3,800. Looks like the downtrend that we've seen since mid-August remains intact. Now, just a word on the rally that we had yesterday, 3% rally. I think that was the biggest in about 2 years. Taking the 2-day rally, or the rally from earlier weekly lows, to over 6.5%. But there's one thing that you got to remember, guys, and we've spoken about this in the past, but the biggest intraday rallies excuse me, are often seen, or nearly always seen, in the middle of a bear market because of aggressive short covering, or the fact that sentiment can swing so rapidly in either direction. So when you see these big moves, that don't be declaring victory. What you want to see for a prolonged bull market is actually smaller intraday gains. So I mean, let's go back to the bull markets of 2021. You can see that the intraday gains are small, 0.2, 0.3%, 0.1%, 0.2%, 0.3, 0.5%. And then you go back to here and it's like 0.8%, 0.6%. I mean, that bit was actually quite rapid. But you get my drift. What you want to see in a bear market for it to be sustainable over the period of quarters or years or whatever is smaller intraday gains. These big aggressive moves higher are usually only seen during bear markets. But yeah, anyway, I think this downtrend is probably going to continue for now. But we're going to have to see how the US data this week goes. Just quickly, oil as well. It's broken above its 21-day moving average thanks to OPEC's. They've now agreed on their cuts. I mean, what was the exact thing that they said? You can scroll back a little bit. OPEC cuts to take into effect from November. See if we can get the exact number. Well, anyway, they were talking about 1 million. So that's been supporting oil prices in the last couple of days. We're now sort of probing the upper 80s per barrel, but we've got the 50-day moving average here. Are we going to be able to get above 90, which is, here's 90. 90's been acting as resistance. I am not convinced given the economic backdrop, basically the macro backdrop. It looks like the market's priced in OPEC for now, so I think we could be looking at another reversal lower in oil and a retest potentially of these lows. But anyway, what are we thinking about for the rest of the week? Let's just quickly recap. Okay, we've got BOJ speak, ECB minutes, plenty of FOMC speak. They're going to be hawkish. BOC governor speaking as well. Unemployment claims out of the US. These have been falling recently, showing that the US labour market remains very, very tight. And then the big event is, of course, this on Friday, the official US labour market report. We're going to be looking at unemployment rate. We're going to be looking at the number of jobs added. We're going to be looking at the rate of wage growth. All these considerations are important. And depending on, if generally the report is stronger than expected, then expect further upside in yields, further upside in the dollar, further weakness in stocks, and vice versa. If it's a weak report, then it could spur a bit of hopes that the US labour market is finally weakening, which means that the inflation outlook is improved and the outlook for Fed rate hikes is a little bit lessened, which could be good for sentiment. And then the same you know, we've got this Canadian jobs data as well, which the loony traders should be watching. But yeah, guys, hope you enjoyed the video, and I will see you all in the next one.